All right, let's get started. Today, we're heading out on a bit of an adventure, exploring a part of the investment world that can be really rewarding: emerging market debt. So let me just kick things off with a question for you. Do you ever look at your investments and just wish they were working a little bit harder for you? Generating some more meaningful income? If you're nodding your head, then you are definitely in the right place. So what is this place we're exploring today? Well, it's called emerging market debt, and don't let the name intimidate you. It's actually pretty simple. These are basically just bonds. Think of them as IOUs that are issued by governments or even big companies in developing countries. We're talking about places with really dynamic, fast-growing economies like Brazil, Mexico, Indonesia, and Vietnam.
Now, you might be asking, why would an investor from, say, the US or Europe even look at these markets? Well, every good adventure has to have some kind of treasure at the end of it, right? And when it comes to emerging market debt, that treasure is the chance to get much, much higher yields.
Check this out. In a world where interest rates in developed countries have been practically on the floor for years, a number like this, well, it's pretty hard to ignore. This is really the heart of the appeal, the opportunity to earn a lot more income on your money. And to really see what I'm talking about, look at this comparison. On one side, you've got emerging market bonds, and on the other, you've got something super safe, like a US Treasury bond. The gap in the yield they offer can be absolutely huge. So the big question is, why? What's the catch?
Well, the returns really come from two main places. The first one is that high interest income. Because these countries are seen as having a bit more risk, they have to offer a higher interest rate to convince people to invest. You can think of it as a risk premium. Basically, you're getting paid a bonus for being brave. And second, there's the chance that the bond's price itself could go up as the country's economy gets stronger.
But, of course, no treasure hunt is ever completely safe. Higher potential rewards pretty much always come with higher risks, and it is absolutely crucial that you know where the dangers are hiding on the map before you start. Okay, the first risk is a really sneaky one: currency risk. Just imagine this. You invest in a Brazilian bond and you earn a fantastic return in the Brazilian real. But what if, over that same time, the real loses a lot of value compared to the US dollar? Well, when you go to convert your money back, poof, your gains could shrink or even get wiped out completely. This is a huge deal, especially if you're invested in bonds that pay out in the local currency. Next up is something called sovereign risk. Now, that's just a fancy term for country-specific risk. We're talking about things like political instability, sudden changes in government policy, or social unrest. Any of that could suddenly make it harder for a government to pay back its debts. The ground you're standing on can be a little shaky sometimes.
And the third big one to watch out for is liquidity risk. Think of this like getting caught in a crowded room when someone yells fire. When the markets are calm, it's usually easy to buy and sell these bonds. But if there's a global panic and everyone rushes for the exit at the same time, it can be incredibly difficult to sell your bonds without having to take a major loss on the price.
So you've got these incredible yields on one hand and these pretty serious risks on the other. How on earth do you navigate this world safely? Well, this is where having a good guidebook comes in. There are definitely smart ways to go about this. The first thing you've got to do is choose your path. You can go for bonds that are paid out in a stable currency, like the US dollar. That helps you sidestep that currency risk we just talked about. Or you can go for local currency bonds. They often have even higher potential returns, but they also come with a lot more volatility, meaning their prices can swing around like crazy. So here are 3 essential rules for the road. Number 1, diversify. Don't try to be a hero and pick the bonds of just one country. It's much smarter to use a fund that spreads your money across many different countries. Which brings us to rule 2, which is really part of rule 1, avoid putting too much in any single country. It's that classic advice, right? Don't put all your eggs in one basket. And third, keep an eye on the US Fed. When it raises interest rates, it can act like a giant vacuum, sucking money out of emerging markets, which can really hit their bond prices. So there you have it. We've seen the treasure, those really attractive high yields. And we've mapped out the dangers: currency swings, political surprises, and getting stuck when you want to sell. It's a journey that offers a lot, but it definitely isn't for the faint of heart. It requires a real tolerance for those ups and downs. Which leaves us with one final thought. Knowing everything we've talked about, the potential rewards and the very real risks, is this high-yield adventure one you're actually ready for?